Students, my name is Mr. George, your financial accounting teacher. In today's class, we are looking at the concept of hire purchase accounts, okay? Hire purchase accounts. Now, let me start by explaining this scenario. Look at this. Let's take, for example, we have one Mr. S, which is the seller, a seller of certain goods, okay, and the goods is delivered. The goods is delivered to Mr. B, okay, Mr. B, which is the buyer, all right, which is the buyer. Then Mr. B agrees. Mr. B agrees, okay, to pay what we call a periodical installments, all right, installments, payments of fixed amount to Mr. S, a periodical installment of fixed amount. Take note of fixed amount, okay, all right. So in this case, Mr. S can also be called a vendor, and Mr. B is known as the hirer if something like this happened, okay, because Mr. B is still paying periodic installments, all right, the ownership still remains, all right, the ownership still remains with Mr. S. Mr. B cannot sell these goods. He cannot sell it because he's still making periodic payments. That's the agreement. So this is an hire purchase agreement. This scenario is called an hire purchase agreement. Mr. B only possesses the goods. It's under his possession, all right? He cannot sell the goods. He can only make use of the goods. Then he will be paying a periodical installments, okay, until full price. So once the full price is paid, okay, once the full price, take note of that, the full price of what, of the goods is paid, then the ownership will be transferred to Mr. B. So Mr. B can do anything with the goods, okay, class. So this concept is called hire purchase. So what is hire purchase, class? Write it down. Hire purchase is nothing but a system of buying under which goods are acquired with payment made in installments. So the system of trading enables the customer to enjoy, it will enable Mr. B to enjoy the goods even though he has not finished paying it, all right. So hire purchase, like I said, is a system whereby you buy, all right, you acquire goods or you buy goods with payments made in installments, okay, class. Let's quickly look at some common terms, okay. Number one, we have what we call the cash price. Cash price, okay. What is cash price? The normal selling price of the goods, the normal, okay, the normal selling price. That's what we call the cash price of the goods without interest. That's the normal selling price, all right. Then we have what we call the hire purchase price. The hire purchase price, okay. What is hire purchase price? Is nothing but the cash price plus hire purchase interest, all right, hire purchase interest. Take note of that. Then we have hire purchase interest. Hire purchase interest is nothing but hire purchase price, the difference minus cash price will give you the hire purchase interest, okay. Then we have what we call the initial deposits. Okay. When agreement is made, let's say the cash price of goods, the cash price of the goods is, let me illustrate that with 50,000, all right, is 50,000. Then the buyer can decide and said, at the beginning the period. Let me pay 20,000. All right. So this is what we call initial deposits. Okay. So once you pay 20,000, then it remains 30,000. Then this 30,000 now will be spread to period 1, period 2, period 3. Okay. And it must always include then interest. Higher purchase interest will be calculated on the balance. Are you with me now? The higher purchase interest will always be calculated on this balance. All right. Okay, will be calculated on the balance. Then it will now be paying part of this 30,000. Take note, it will be paying part of this 30,000 and the higher purchase interest on in each period. So that amount that contains part of this 30,000 and the interest is called the installment. So take note, the installments will contain part of the balance plus higher purchase interest. Okay, part of the balance, take note, part of the balance. That's what we call installments. So the sum payable by the higher purchase buyer, it is normally paid by the higher purchase buyer. Okay, to liquidate this balance, to liquidate the balance. Okay, class. So when we solve a question, I'm going to explain further. All right, take note of that. Now this higher purchase interest, all right, the higher purchase interest to the buyer is an expenses, is an expense. The higher purchase interest to the buyer is an expenses. Write it down. But to the seller is what? An income. So I'm going to stop here. I remain Mr. Sesi George. All right. So try to replay the video for proper understanding. And if you like the video, please do share with your friends. Share with your friends. Subscribe to my YouTube channel and share with your friends. Okay, so that anytime I drop any video, you always get the information. Okay, always remember to remain safe. Bye.